Ladies and gentlemen, welcome back to Vietnam Stock Market Opportunities. It's an honor to be with you today. And if you want to open a legal trading account, please contact us with the email Vietnamstockmarket.entry@gmail.com. Telegram Vietnamstockmarket.entry with the phone number is 8491-432-6556. Or you can also scan the two QR codes on the screen so that we can support you. And the other way to contact with us is please follow and subscribe to the channel name Areca Capital Channel. The owner of this YouTube channel is Areca Hồng Nguyễn. She's a professional financial advisor. You can contact her with the email hongzhangnguyên@vcsc.com.vn with the phone number is 8491-432-6556. And we always welcome you to our office on the 11th floor, 109 Trường Đạo Street on Kim District, Hà Nội, Vietnam. And today we're going to update to you about the Vietnam Strategy 2023. Let's continue with oil and gas sector. Gas and LNG fired power plant capacity to expand 4 times over the next 10 years, spurring growth. Check-up market update. A recover and tighter market supports higher day rates and utilization rates as well as longer contract terms. Following the plunge of oil prices in 2014 to 2016, under investment in exploration and production activities pushed drillers to restructure, merge, and or scrap old rigs. This situation has weighed on the current rig supply as demand has rebounded, leading to a tight market with both higher day rates and utilization rates. According to IHS Markets, the JUIC 361 to 400 WD day rate in Southeast Asia rose from 70,000 US dollar in early 2021 to 95,000 US dollar in Q3 2022 and 109,000 US dollar in November 2022, which was driven by a race to lift production due to the Russia-Ukraine conflict and demand recovering post-COVID-19. In addition, the jack-up utilization rate in Southeast Asia recovered from 60% in early 2021 to 90% in Q3 2022 and remained at 90% in October to November 2022. IHS Markets expects a brighter outlook for the global jack-up markets, which is driven by a projected 95% utilization rate and day rate of 150,000 US dollar at end 2023. As such, IHS Markets forecast the JU 301 to 360 IC WD day rate in Southeast Asia will rise from 73,000 US dollar to 87,000 to 73,000 US dollar to 120,000 US dollar. In addition, as well and gas operators have recently become fearful of not securing drilling rigs. Leasing contracts, we have signed longer-term contracts that have thus made the market even tighter. 2023 outlook for a urea sector. Following our fertilizer producer sector update report, record high 2022 net profits after tax to support attractive DPS yields. Dated November 15, 2022, we present below key summary. Global urea prices have cooled out but increased 33% year-over-year in 2022. The average Middle East urea price in 2022 was $702 per ton, more than 32.8% year-over-year. Within our expectation, in October to November 2022, the average Middle East urea price was flat compared to the Q3 2022 average of $626 per ton. Industry players expect urea prices to rebound from the recent correction due to the peak season for urea occurring in Q1 2023. We forecast the average Middle East urea price at $539 per ton in 2023, approximately less than 25% year-over-year, which is partly due to increasing exports to China. China's fertilizer export restrictions have been effective since mid-October 2021, and its 10 months 2022 urea exports volume was 59% lower year-over-year. However, industry players state that Chinese urea exports should increase in 2023 due to the country's competitive production cost for its coal-based urea plants and gas-based urea plants in Europe. Regarding Russia, it's imposed an export quota of 8.3 million tons for nitrogen fertilizers, urea, ammonia, and ammonium nitrates. Until December 2022, Russia recently confirmed that it will impose an export tax on nitrogen-based fertilizers, including urea, of 23.5%. The market could expect urea export volume from Russia to decrease, which should support urea prices. However, industry players state that imposing an export tax on fertilizers will only have a slight positive impact on the global urea markets. Global urea price movement. Urea prices to remain high in 2023 forward due to high gas and coal prices. We maintain our 2023 to 2027 forwards Middle East urea price forecast. Specifically, we forecast Middle East urea prices of $539 per ton in 2023 and $350 to $400 per ton in 2024 to 2026 forwards, as we expect oil, gas, and LNG costs to cool over the long term. In this October 2022 gas report, the IEA raised its average 2022 gas price forecast by 16% to $29 per MMBTU compared to its July 2022 report. In addition, CME futures as of October 2022 implied average LNG prices of $31 per MMBTU in 2023 respectively, suggesting continuing decline of the urea supply from Europe next year, which should support urea prices. Furthermore, the outlook for prices of coal inputs for 30% of urea produced globally remains high. Therefore, we maintain our 2023 to 2027 forwards Middle East urea prices. Vietnamese urea prices are following global urea prices. We expect a 7% gap between DPM and DCM's ASPs compared to international urea prices in 2023 to 2026 forward. In 9 months 2022, DPM and DCM's ASPs were 10% to 15% lower compared to the average Middle East urea prices, which was partly due to both companies providing support to farmers. We assume a 7% discount for DPM and DCM's ASPs compared to the average Middle East urea price in 2023 to 2026 forward due to the positive impact from the US dollar's appreciation compared to the Vietnam zone on domestic urea selling prices and lower expected support for farmers. We expect domestic urea consumption to pick up in 2023. According to DPM, domestic fertilizer demand declined 20% to 30% year-over-year in 9 months 2022 due to high fertilizer prices. Therefore, we expect domestic urea consumption to recover and forecast urea prices to fall 25% year-over-year in 2023. We forecast flat year-over-year sales volume for DPM and DCM as we believe both companies will reserve some inventory for 2023 and prioritize the domestic markets over international markets following robust exports in 2022. Middle East urea prices compares to the domestic urea prices. 2023 outlook for Vietnam's petroleum sector. Vietnam's petroleum consumption rebounded strongly in 2022 from the low base in 2020 to 2021. Due to strict social distancing measures in 2021, petroleum consumption declined 7.7% year-over-year that year, which was even worse compared to the 5% year-over-year decrease in 2020. Based on production and export data from the MOIT, we estimate Vietnam's petroleum consumption rose at 15% year-over-year in 9 months 2022 as a result of a recovery in transportation demand. PLX 9 months 2022 domestic volume growth was even higher at 20% year-over-year as it had to ensure the domestic supply when other petroleum distributors temporarily stopped operation during Nissan refinery. Sudden shutdown lowers utilization rates in H1 2022, and the fuel shortage starting in early October 2022. Vietnam's petroleum demand and PLX domestic volume growth. For full year 2022, we estimate Vietnam's petroleum consumption to increase 15% year-over-year to 22.1 million tons, with domestic supply meeting 69% of the demand and imports meeting the remainder. We expect imports to account for 30% of national demand in 2023 forward and assume that NSR's utilization rate will recover to 93% in 2023 from 77% in 2022, which will ensure a stable domestic petroleum supply when BSR is expected to undergo 50 days of maintenance in 2023. According to the government's National Energy Master Plan, we forecast Vietnam's petroleum consumption to rise 4.1% PA in 2022 to 2026 forward, which mainly corroborates the IEA's expected global growth rate. Vietnam's petroleum consumption forecast. We expect the government will have further review on base price components in 2023 to better reflect actual petroleum distribution cost and solve the supply shortage. In early Q3 2022, the MOIT targeted for BSR and NSR to operate at full capacity. The MOIT also planned for a domestic supply of 3.9 million tons in Q3 2022, 72% of demand, and 4.4 million tons in Q4 2022. 80% of demand compares to 60% in H1 2022. However, losses at private petroleum wholesalers and distributors forced them to stop imports and temporarily shut down stations. According to Vietnam Customs, Q3 2022 preliminary data, gasoline and diesel imports in Q3 2022 fell 40% and 35% compared to Q2 2022, respectively. Additionally, BSR had to operate at 110% of its design capacity to ensure the domestic supply. Actual distribution costs, storage and transportation, and premiums. The adjustment factor in gasoline diesel supply contracts have been increasing since late 2021, whereas the premium and transportation regulated cost components in petroleum retail prices to cover costs for petrol distributors did not increase correctly. Accordingly, this situation has hurt the profit margins of PLX, OIL, and other smaller distributors as they have had to sell at lower prices than input prices. Many small distributors with weak financial capacity will have to continue limiting their sales volume or temporarily shut down their petrol stations unless government regulators can review and reflect actual costs into base price components adequately and punctually so they can at least break even. On the 11th October 2022, the Ministry of Finance and MOIT increased the premium and transportation regulated codes in petroleum retail prices for domestic sources to help cover costs for distributor and resolve the supply shortage. These ministries agreed to raise transportation regulated cost freight from refineries to the ports of distributors to 290 Vietnam dong from 40 Vietnam dong, 280 Vietnam dong from 70 Vietnam dong, and 240 Vietnam dong per liter for 92 RON, 95 RON, and diesel respectively. Additionally, the ministries increased premium of the domestic price component to 1,320 Vietnam dong to 1,340 per liter by 350 Vietnam dong per liter for RO and 90 and RON 95 and 30 Vietnam dong per liter from 11 Vietnam dong per liter for diesel. On the 11th November 2022, the two ministries raised the transportation regulated cost by 30% to 80% to deal with import sources. We estimate these two adjustments increased the base price by 2% to 3%. Ministry of Finance adjustments on transportation regulated costs freight from overseas to Vietnam, valid on 11 November 2022. Retail petrol price formulas under Decree 95, pricing at elements of base price. Historical regulated cost per liter Differences between Decree 83 and Decree 95. Gross refining margin outlook. As shown in Figure 425, Singapore gross ref- refining margin skyrocketed to over 30 US dollar per barrel in Q2 2022, tripling compares to 10 US dollar per barrel in Q1 2022, which was due to China's partial reopening in early July 2022 and concerns on tightening gasoline and diesel supplies due to the Russia-Ukraine conflict. In addition to a continuing demand recovery and low global inventory level. In Q3 2022, the GRM dropped 30% to 20 US dollar per barrel from the high base in Q2 2022. However, this was still quadruple the 10-year average of 5.3 US dollar per barrel. Brent oil prices and Singapore gross refining margin. The surging crack spread in Q2 2022 can be mainly attributed to the gap between supply and demand. As shown in Figure 426, global refinery demand for gasoline, jet fuel, per kerosene, and gas diesel fell to 65%, 30%, and 80% of their respective 2019 levels in April to May 2020 and remain low until September 2020 due to COVID-19. Global refinery product demand compares to 2019. This demand fall led to a decline in refinery utilization rates, which result in global crude distillation capacity declined by 3.8 million barrel per day from March 2020 through mid-2022, according to the International Energy Forum and IEA. Although this decline only accounted for 4% of global capacity, it could take years for new refineries production to replace this decrease. Meanwhile, owing to the recovery from COVID-19 and started in 2021, global petroleum demand increased 5.6 million barrels per day until mid-2022, which created a 9.4 million barrel per day higher gap between supply and demand. This gap increased as the Chinese government decreased exports to prioritize its domestic markets. Furthermore, the diesel markets was already tight before COVID-19, and its demand growth has been resilient compared to jet fuel or corrosion, which is partly due to the EU seeking more diesel imports in order to become less dependent on Russian fuel. Global fruit distillation utilization by region. We expect the gap between supply and demand will narrow in 2023 as global energy demand will be threatened by a potential economic slowdown and increased refinery distillation capacity, which is supported by a lower threat from COVID-19 and potential easing of the Russia-Ukraine conflict. We forecast a 25% to 30% year-over-year decline in the gasoline crack spread in 2023. A global economic slowdown could also dampen gasoline demand. However, we believe the diesel market will remain tight, stemming from the potential reopening of China and high gas prices globally, and thus forecasts a 14% year-over-year decline for the diesel crack spread in 2023. According to Bloomberg, the average gasoline crack spread in Q3 2022 decreased 60% Q-of-Q from Q2 2022 high base to $11 per barrel, while the average diesel spread was $36 per barrel due to more resilient diesel demand growth compared to gasoline. In 2013 to 2021, BSR's average GRM of $7 per barrel was higher than the average landmark Singapore GRM of $5 to $6 per barrel, which was mainly due to a lower tax rate imposed on BSR's products compared with imported products. Going forward, we project an average GRM of $12.5, $8.6 per barrel for BSR in 2022 to 2023 forwards, respectively, followed by a decline in $5 to $8 per barrel in 2024 to 2026 forwards, as we expect crack spreads to remain high in 2022 to 2023 due to the tightened supply as a result of the Russia-Ukraine conflict, along with a demand recovery and low inventory levels. However, we expect BSR's GRM to decline by an average of $1 to $2 per barrel in 2024 to 2026 forwards as one. We assume crack spreads will normalize to around their historical average starting in 2024, as we forecast both crude oil and petroleum prices to normalize because increasing global spending and the ONG setters should help to improve the supply availability, and two, as the tax rate imposed on imported gasoline will be progressively reduced from 8% in 2020 to 2022 to 5% in 2023 and 0% from 2024 onward. Price outlook for crude and oil product tanker rates in 2023. Per Bloomberg data, the Areca time charter tanker rates Indonesia to Japan jumped 114.4% year-over-year in 10 months 2022, while the Areca tanker spot rates West Africa to US Gulf Coast skyrocketed by 265.5% year-over-year in 11 months 2022. According to Clarksons and PVT, the crude tankers market outlook remains positive due to one, underlying tanker fleet growth expected to be very limited with a small number of orders booked, and two, crude trade demand projected to grow as a result of significant shifts in trade flows to longer haul routes, gas to on switching, and improved China's demand despite OPEC's oil production cuts. Brent oil price and Aframax crude tanker rates, oil product, chemical, LPG, and bulk tanker rates. According to PVT and Clarksons, the outlook for the oil product chemical segment also remains positive. Supportive demand trends are continuing with growth in ton-mile trade as a result of expected significant shifts in trade patterns after the EU ban on imported products from Russia comes into effect in February 2023. Furthermore, underlying tanker fleet growth is expected to be limited in 2023 to 2024. Stock recommendations for 2023. Petro Vietnam Gas. Gas is the monopoly operator of gas transportation and trading in Vietnam. It provides input feedstock for 100% of Vietnam's gas thermal power plants, 70% of urea producers, and 100% of industrial parks. Gas also has a 70% market share in the LPG wholesale business. We expect gas will benefit from high oil and gas prices, which should allow the company to enjoy forecast EPS growth of 60% in 2022. In the long term, we expect gas will benefit from its LNG projects, including the Thị LNG terminal, phase 1 that is set to contribute 7% of gas net profits in 2023. In addition, with 1.4 billion US dollar cash on hand, we believe gas will contribute to expand the Thị LNG terminal phase 2 and execute the Midson LNG project to increase its sales volume by 50% over the next 5 years. We expect profits from gas transportation driven by LNG projects and new gas pipelines will outweigh weakening profits from the gas trading segment when cheap gas fuels run out of reserves. As such, we forecast an EPS CAGR of 23% in 2021 to 2026 forwards. Bình Refinery BSR operates the Dung Refinery, which was crude run capacity of 148,000 barrels per day, 6.5 million tons. BSR is a dominant player in Vietnam's petroleum sector and has a 30% market share in petroleum products. We expect BSR's 2023 net profit after tax amount will drop 50% year-over-year to 7.4 trillion US dollar, still close to the previous critical peak in 2017, which will be driven by one, crack spreads cooling from their highs in 2022, and two, volume decline due to 50 days of expected maintenance from 2023 onwards. Even though we believe BSR's GRM will follow regional GRMs, our projection of BSR GRM being 5 to 8 US dollar per barrel over the next 5 years should support sufficient cash flow to execute the company's planned expansion of project upgrades to expand its capacity to 171,000 barrels per day and maintain its dominant market share in Vietnam. Our forecast for BSR's 2023 forward PB is 0.8 BSR's share price plunge 50% in H2 2022, underperforming Brent oil prices and regional peers due to a sharp correction in Vietnamese equity markets. As such, we believe BSR has fallen below its intrinsic value. Petro Vietnam Cà Mau Fertilizer DCM is one of Vietnam's two largest urea producers, 32% market share, and has a strategic location trusted brand name and high quality urea products. Vietnam is the world's third largest prime exporter, leading to stable urea demand growth of 2% according to Agromonitor, which coupled with rising export potential and increasing domestic demand when urea prices decline support a stable urea sales volume of 850,000 tons. 106% utilization rate for DCM in 2023 to 2026 forwards. Although we forecast DCM's 2023 forwards net profits to decline year-over-year, it will remain high and be equivalent to the previous peak in 2011 to 2012. In addition, DCM's financial capacity is strong with net cash of $307 million and a net cash equity ratio of 71% of entering Q3 2022. In addition to no significant capex planned for the foreseeable future, this factor should support our projected cash dividend of 1,800 Vietnam dong to 2,000 Vietnam dong per share. Petro Vietnam Fertilizer and Chemicals DPM. DPM is the leading urea producer in Vietnam and has a 35% market share, trusted brand name, and strong nationwide distribution network of 3,000 points of sale. We forecast this DPM's 2023 forward net profits after tax to decline 40% year-over-year, mainly due to our projected urea ASP decrease of 21.4% year-over-year. However, this forecast implies that we assume DPM's net profits after tax MOI could remain as high as its previous peaks in 2011 to 2012. DPM has a strong financial profits with net cash of 8.3 trillion Vietnam dong, $339 million, and a net gearing ratio of less than 34.9% as of end Q3 2022, which support the company to offer a robust cash dividend of at least 5,000 Vietnam dong per share in 2022. Outperform Petro Vietnam services. PVS is the leading provider of non-drilling technical services in Vietnam's oil and gas sector. PVS provides various oil and gas technical services, including seismic survey, mechanics and construction, operation and maintenance, and ship, port and floating oil strategy. We are optimistic about PVS recovery with job opportunities from gas, LNG, and offshore wind power projects. We forecast recurring EPS to be flat year-over-year in 2023 forward, before rising to 56% in 2024 thanks to more jobs for the MNC segment. In addition, we expect an end 2022 projected MNC backlog of $3 billion and stable FSO and FPSO profits to have PVS to achieve our 2021 to 2026 forwards. Recurring EPS CAGR of 9%. We expect PVS will benefit from regional wind power developments in the near term. In addition, PVS will have opportunities to become the EPC contractor for domestic offshore wind power projects when Vietnam's Power Development Plan 8 is approved. Petro Vietnam Drilling PVD is the leading domestic provider of drilling services for the oil and gas industry, has a 50% market share in drilling services. PVD has strong financial capacity and well-managed cost control, which we believe will have the company to benefit from rising drilling demand in the region. We expect a robust recovery in 2023, with projected recurring net profit after tax MI jumping 21 times year-over-year from the minimum based in 2022 due to higher jack-up day rates and the drilling fleet operating at 98% capacity. We expect higher day rates will outweigh higher operating costs when more of PVD's rigs will work internationally. Petrolimex PLX is the leading petrol distributor in Vietnam and has a 50% market share. In addition, PLX has the largest nationwide storage capacity and a nationwide distribution network of 2,700 COCO, company-owned, company-operated, and 2,800 DODO, dealer-owned, dealer-operated petrol stations, which can together account for 35% of total petrol stations in Vietnam. We forecast PLX earnings to decrease by 92.4% year-over-year in 2022, which is driven by the company having to sell at higher volume to relieve the domestic supply shortage as well as premiums, transportation regulated costs in base prices not being enough to cover actual premiums and costs. We expect a further base price review in 2023. We forecast earnings to recover by 2.6 trillion Vietnam dong and supported by profits per liter recovering 8% year-over-year. Moreover, the PG bank divestment is a potential catalyst in 2023. Over the long term, PLX should benefit from the government's projected long-term petroleum demand growth of 5.5% in 2021 to 2026 forwards. Furthermore, PLX has the potential to develop non-oil services as station and LNG storage and supply. With strong financial capacity, we expect PLX to pay a DPS of 1,200 Vietnam dong, 1,500 Vietnam dong in 2023-2024 respectively. Petro Vietnam Transportation, PVT is the dominant crude oil transporter for BSR and has a stable and high margin floating oil storage business, 10% market share. These two businesses have generated a stable 50% of PVT's total gross profits over the past 5 years. PVT has been renewing its contracts, and we expect the company's 2023 tanker rates will be partly in line with global rates that have risen since 2022. As a result, our forecast for 2023 forwards recurring net profit after tax MI growth is 18% year-over-year and mainly supported by the crude and oil product chemical segments. Additionally, we forecast flat 2023 forwards reported net profit after tax MI, which is driven by 18% year-over-year recurring net profit after tax MI growth and offset by not having tanker liquidation gains as In 2022, PVT has strong financial capacity with 3.7 trillion Vietnam dong, 149 million US dollar of cash on hand at end Q3 2022. A panicked share prices of cover stocks compares to plant oil prices and urea prices for fertilizer producers. Company names and codes. Yeah, and that brings me to the end of my presentation today about oil and gas sector. If you want to open a legal trading account, don't hesitate to contact with us with the information on the screen so that we can assist you. So have a nice day and see you next time.